China currently controls over 90% of the global processing and separation capacity for heavy rare earth elements. The Western world is in a forced race to break that monopoly to secure the materials required for advanced electronics, electric mobility, and national defense. Critical Metals Corp has positioned itself as the architect of an independent Western supply chain. The company holds geological assets with immense strategic value. The question for investors is whether that geopolitical utility justifies the severe near-term execution risks and equity dilution currently priced into the stock. This map shows the location of the company's primary competitive moat, the Tanbreez project in southern Greenland. Situated at this southern tip, Tanbreez contains a 4.7 billion metric ton multi-element resource. Crucially, an estimated 27% of that resource consists of heavy rare earths. The secondary asset is the Wolfsberg Lithium project, located in Carinthia, Austria. This fully permitted site is positioned to become Europe's first local lithium concentrate producer. Geologically, the West has the raw materials required to compete. However, possessing raw ore in the ground does not automatically translate into intrinsic equity value for public shareholders. Critical Metals Corp is entirely pre-production. Its current valuation relies strictly on 3 future cash flow mechanisms. The first revenue engine is the extraction of heavy rare earths at Tanbreez. Elements like zirconium, tantalum, and hafnium command high market premiums due to their absolute necessity in aerospace and defense manufacturing. The second engine is lithium concentrate production at Wolfsberg. This asset is structurally de-risked by a long-term offtake agreement, ensuring a committed buyer once extraction begins. The third, more immediate cash flow mechanism is the planned liquidation of the company's existing ultra-high purity copper powder inventory, currently held on the balance sheet at $15.8 million. On paper, these 3 pillars form a vertically integrated, highly attractive supply chain. In practice, generating actual revenue requires flawless operational execution across multiple international jurisdictions. That operational execution is currently faltering. Significant production delays are compounding the inherent risks of mine development. The capital expenditures required to transition these sites from exploration to extraction vastly outpace the company's existing liquidity. This imbalance prompted auditors to issue a formal warning regarding substantial doubt about the company's ability to continue as a going concern. The institutional market has reacted to this financial distress. Analysts at Seeking Alpha recently downgraded the stock to a hold rating, explicitly citing these ongoing capital constraints and production timelines. Simultaneously, the company filed an SEC registration for the resale of 2.74 million shares by Gem Yield Bahamas. Critical Metals receives no proceeds from this specific sale. This block of 2.74 million shares introduces a massive supply overhang into the float. Regardless of the ore's theoretical value, this dilution establishes a hard ceiling on near-term share price appreciation. The latest half-year results quantify the financial strain. The company reported $768,000 in revenue against a net loss of $120.4 million. Software companies scale linearly. Mining companies do not. They require hundreds of millions of dollars in upfront infrastructure spending years before the first ton of commercial ore is processed. Investors absorb these early losses to capture future pricing power. The global market operates in a structural deficit for heavy rare earth elements. Because Tanbreez yields a 27% concentration of heavy rare earths, Critical Metals will have the leverage to dictate pricing terms to Western defense contractors and automotive manufacturers that have no alternative suppliers. We can already see this pricing power materializing. BMW has issued a $15 million prepayment to secure future lithium output from the Wolfsberg project. Taking a position in this stock requires underwriting years of zero-margin capital destruction, purely on the calculation that this guaranteed future demand will eventually yield exponential cash flows. A surface-level review of the balance sheet shows a remarkably low debt-to-equity ratio of just 1.6%. The catch? Critical Metals avoid traditional bank debt, but is heavily leveraged through complex warrants. Value fluctuations in these equity structures triggered an $80.1 million non-cash loss, distorting earnings. Meanwhile, actual cash liquidity rose to $80.9 million, sourced from $85 million in PIPE financings. Yet this new capital faces deeply negative free cash flow and the extreme operational burn rate required to build an Arctic mine. The bank account is capitalized for now, but the combination of heavy operational cash burn and toxic warrant liabilities creates a persistent downward gravitational pull on shareholder equity. This chart illustrates the current valuation dichotomum. Trading near $7 per share, Critical Metals holds a price-to-book ratio of 13.4 times. The U.S. metals and mining sector average is 2.7 times. Analysts at Freedom Capital have issued a bullish $15 price target, but the market is heavily discounting that projection. Comparing this data table, Tanbreez's projected $2.5 billion after-tax net present value is weighed against active peers to see if geology justifies the premium. While Tanbreez has superior resource scale, it projects an after-tax internal rate of return of 42%. For comparison, the active Mountain Pass mine boasts a 60% IRR on lower initial CapEx. All of these fundamental models are subordinate to one overriding macroeconomic threat: China's geopolitical ability to retaliate against Western supply chain independence. If China chooses to artificially dump its processed heavy rare earths onto the global market at a steep discount, it would instantly render the billions of dollars spent developing Western mines economically unviable. Paying a 13.4 times premium for critical metals requires assuming flawless internal management execution, operating within a global market where the primary competitor literally controls the pricing mechanism. Based on the financial constraints and execution delays, the institutional recommendation for Critical Metals Corp is a definitive hold. The 12-month target price sits at $7.50 per share. The bull thesis is anchored in geology. Critical Metals controls a 27% heavy rare earth grade in a Tier 1 geopolitical jurisdiction that Western governments desperately need. The bear thesis is anchored in the balance sheet. This pre-revenue entity is burdened by active share dilution, going concern warnings from auditors, and an extreme valuation premium relative to the sector. Critical Metals holds a highly strategic geopolitical asset, but its current capital structure is too toxic to warrant a buy rating for retail shareholders today. Investors seeking exposure to the critical minerals macro trend have defensive alternatives that avoid these extreme structural risks. The primary alternative is MP Materials, trading on the New York Stock Exchange. MP Materials operates the Mountain Pass mine in California. It offers an actively producing, heavily de-risked US-based asset that already generates cash flow. A second alternative is Defense Metals, trading on the TSX Venture Exchange. Defense Metals provides North American exposure through its Wichita project. It trades at significantly lower entry multiples and avoids the complex warrant overhang suffocating Critical Metals. Are Western geopolitical tailwinds strong enough to save pre-revenue mining operations, or will the balance sheet realities always win out? Let us know your strategy in the comments, and subscribe for our next deep dive equity analysis.